if we are all correlated to the money printer, then what's the difference? What's the difference between each asset class? What's the difference between each crypto? And the answer, my friends, is your access to liquidity. That's the answer. This is your friend Tommy. We're going to go diving deep. Brrr. This is my head here. The money printer, friends. Everything is correlated to the money printer. We've seen it. I've shown you many charts. I've shown you ultimately at the end of the day, global liquidity index is rising. But what is even the global liquidity index, friends? If you go to TradingView, you can even just type in M2SL and you can see that this thing goes up. Now, a lot of bears, friends, what they'll do, or people who tend to lean bearish, like, for example, Georgie Gammon. I love Georgie. Georgie's awesome. He tends to lean more bearish, a bit more skeptical on like, different surveys and stuff. But what they'll often do is, friends, they always put this chart on a linear. And I'm looking at it like, bro, why use on a linear chart? It should be a log chart. The log chart shows the rate of growth. Okay, so if you put a log chart, it's a difference now. You see, it's going up and to the right. Now, no excuse. Purchasing power is being eroded, which is what we're going to show you today. However, it's going up and to the right. Like, what they try to show is, friends, they try to show that, the debt and everything has gone up a lot. Like, bro, it's been like going up like that, since like forever, literally forever. So it does make you question the bears when they speak about it. You know what I've noticed about bears, friends? And I'm just going to play some Dominando music as well. The bears, bro, if you're going to be bearish on society, why the hell are you bearish on assets and then bullish on the US dollar? Explain that for me. That makes absolutely no sense. Why would you do that? It makes, like, you are literally saying society is going to crumble. Yeah, bro. Do you know the thing that's going to crumble first is going to be the paper that they're just handing out? There's no proof of work to produce the paper. They just press a button. So that's why ultimately, friends, what I've done here for you, I've just dissected every bear, pretty much. Now, not every bear in every case, because there will be periods of time where there's just so much leverage. But I'm just showing you that, see, friends, it's hard to catch a fart in a jar twice. Catching a fart in the jar, we go, oh, yeah, we've topped out. Things are going to go down. Okay, but what you'll find is, over history, people find it very difficult to then get bullish again. Even in the stock market, the S&P 500 to be more precise, I have here the GFC, friends, the great financial cookie, which basically crashed down. The cookie crumbled here. Now, what ended up happening was, this is going to blow your mind. A lot of people made a lot of money short here, but they all gave it back. I'm not even joking. So people were betting on it crashing. And then when this thing happened, friends, all they were seeing was doom and destruction. And they're like, oh, well, sweet, this is going to keep going down and down and down. What ended up happening was the stock market just going up and up and up. They gave back all the gains. So they were all turbo leverage short here. And look, the market just came back and they didn't want to give up. See, this is the dangerous part, man. So they were short and look how fast it bounced back. So you're short from here. You've been betting on this for years. It comes down and then just like it starts going up. And you're like, well, I want to get out here, but it keeps going up again. You're like, oh, I want to get out here. It keeps going up again and again and again. And then what ends up happening, friends, look at this. They think, okay, it's going to crash now. Nope. Goes up and up and up. See that? Do you want to know what happened here? The US debt got downgraded. So the US debt got downgraded and we still did a higher low and we went up. Now, I'm not joking or exaggerating. A lot of hedge funds who were short gave back all their gains. And they just basically, they blew up. They just wasted everything. So they were right to be bearish, but then they couldn't flip bullish in the midst of the terror. You see, because these people who... You got to think about the mindset of somebody to say something is bearish, going to take everything down. It's very difficult for them to predict that the market is going to price that out earlier than you can think of. That's what happens in the depression, friends. So why did the stock market go up after that GFC, right? It's because it starts pricing in the future. It starts basically saying, oh, GDP is going to be good in 6 to 12 months. Not today, 6 to 12 months. And it starts rotating up. That's why it's really difficult to basically always be bearish. Now, back to the assets, right, friends? If you want the lowest risk and most liquid, you hold cash or short-term treasuries. So if you imagine a duration line, friends, what I'm going to do now, just draw on here for you, just so we can make it nice and simple. We have the chart right here. So we are here today. This is year 0. And then you have a future point in time. Okay, so here we are today. Now, right here, friends, so if you want short-term treasuries, you get cash. And short-term treasury, if you want access to short-term liquidity. Okay, so you want short-term treasuries, you get cash, you put them in the same pile, you can access them whenever you want. So if you have a bill that comes up or some fees or medical expenses, you can access them pretty quickly, okay? But your compensation for holding that is very little, isn't it? Because if you're holding the most liquid stuff, cash and short-term treasury, you're just getting the interest rate. You're losing to pretty much the real inflation. So that's what you get. Okay, if you want to live in that world where everything's always going to collapse, the rainy day is always going to come, if you have a high percentage of your portfolio in that, you're going to deal with that. Then we move into stonks. As we move into stonks, you get low cap and high cap stocks with varying liquidity access. So that's where it starts to open up for you, right? So you don't want to touch the bonds anymore. You go, okay, sweet. Now you're into stonk market world. Now there's different stonks, right? There's a small cap. There's like the biotech shitters. There's the mid caps, right? So you move out of the Russell into the mid cap stuff. Then you have the high cap, which is S&P 500. They have varying different levels of liquidity access that you can get, okay? But if we go back to the chart again, right? So the next one, so you have cash here. The next one will be stonks, okay? Stonks. And then you have like T1, T2, T3. So obviously the S&P 500 is the first one. And then you have mid caps. And then you have like the biocap shitters. But so what I'm doing now, friends, is let's say this is like a long period of time. If you want to go then further, look what ends up happening, okay? So accessing liquidity, it's important. It's what makes people act in the fear, right? In the fear, they see the liquidity going down. They're like, oh, I panic. Okay, so that's what everyone's been watching as, you know, as the cycle progresses, no matter what you're looking at, crypto, stocks, or whatever. Now, I have a lovely picture here as well with this Peppy and this nice gun of cash. So the stock market, S&P 500, is the biggest large cap stocks, right? So that's what you know, the S&P 500, it goes up 5 out of 6 years. Most of the time, you don't have to worry about being down 90% after 3 years. So that's when you have the stock market, right? So even if you go to stocks, friends, most of the time, so this is the bad period, right? But most of the time, it's just going up. It's going up, has these periods where it goes down, you know, goes up, has these periods sideways. But most of the time, making new highs. It's great, isn't it? However, you think about that. So in the cash and the short-term treasuries, you can access your money within a month. You don't have to wait. You don't have to hold out for anything. You can get it straight away. With stocks, if you're in the S&P 500, you still have some risk. So you might need to wait a year for it to come back, 1 or 2 years. See, you're starting to like stretch it out now. You're starting to stretch it out. So you have to wait like a bit period of time because, you know, sometimes stocks are like down 10% of the year, 20%. If you want to get back to your price entry, yeah, it might take 1 or 2 years to get back. You see, but for that, you're compensated. So the cash is only going to give you a couple of % interest, but the stock market over time is going to give you like 8% per year, which is much better than the bonds and the cash, right? And then, friends, I'm going to throw out the longest duration here that you can access, okay? Which is, it's interesting how you think about it, okay? So after all these, we come to crypto. You see, crypto. Now, you know what's interesting? Around stocks, friends, you also have gold, okay? Gold. But gold it's weird because gold gives you 8% per year, but you need to hold it for 20 years. So it gives you this insurance aspect that you don't get with stock market of a country, but it could make you wait a long time. You see? So gold is obviously very liquid, but to get gains and to access your gains, yeah, it takes a period of time. So gold, right, it has periods of time where you could access it in short periods, but also you might have to wait like 20 years to get your proper growth, as you get to see. So gold can have like a big period where it just goes nowhere for a while. But then we obviously move into crypto. All right. So as we move into Bitcoin, there is more liquidity risk than stocks. And finally, with altcoins, it becomes extremely risky to rely on them for liquidity access. So this is Pikachu holding up a Bitcoin logo. So Bitcoin, friends, when we're looking at crypto, right, we're moving out further, right, further along the duration curve. Now we have Bitcoin, and now you even have altcoins out here. You see that? So Bitcoin, your liquidity access is worse than stocks for obvious reasons, right? It's, it's more volatile, way more volatile. So what it basically means is, remember, crypto's gains come in the year after the Bitcoin halving. It's like 1 year of expansion and then 3 years of just going down. As you can see here, this is pretty much, of course, the log chart makes it look good. So you have expansion here and then poop, 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 and then we finally go up again, okay? So there's all these vicious periods of these huge 75% drops. You have this long period of where you're like, you can't access your liquidity, right? All the way here as well. So up here, Bitcoin, you can't access your liquidity, all in this zone until finally you go up. And same thing that will happen again. So you get to see this play out in action. The volatility is just insane. Getting back your price near the highs, it sucks. Whereas the stock market's more gentle to you. The stock market's always making a new high, right? So it's like if you buy a new high in the stocks, okay, there's a 5 out of 6 chance it's going to keep going up. But with crypto, inverted, man. It's a 1 in 4 chance you go up, right? That's the odds if you're buying highs. So then we move from that Bitcoin and into the altcoins, right? Which is interesting. So altcoins, they're even more vicious with the liquidity lockup. You see our Bitcoin friends, Bitcoin's recovered the range. It recovers the range faster than the alts. But that's why we're in altcoins, because we know, okay, if Bitcoin recovers its all-time high, alts are within the next 12 months. So that's a long frame of time for most crypto references. 1 year, you multiply it by 4 in crypto. That's like 4 years in the stock market. But really, the calendar is not too bad. I mean, like for the chance at life-changing gains, you just got to wait another 12 months. Most people will take that deal. Wouldn't you agree? So with altcoins, you could be locked up for 3+ years. For example, someone who bought Hex at 30 cents in September 2021 is still down more than 90% after 3 years. And it's of course not just Hex, but pretty much a lot of other things as well, friends. Because, if you're looking at something like Hex up here, this is eHex as well. I mean, like going down, imagine you were buying at like 27 cents here or even 18 cents. I mean, it goes all the way down 99%. So hopefully the things come around because that's the risk, right? Not everything can come around. Not everything will have a strong cult in a community to even bring it back around. But that's, like I said, that's part of the game. That is the game. Okay, so as you can see, you can't access your liquidity. So, if you put in $10,000 into Hex at 25 cents, you can't access it, man. There's literally nothing there. You try to pull it from the liquidity pool, you'll be selling at a very, very low price, okay? However, if you are right about the investment, you will get handsomely rewarded. Delaying gratification and sacrificing liquidity access is how you can get a powerful moonshot return. So in a nutshell, everyone thinks you're crazy because you've thrown money into the abyss. Because you've thrown money into this black hole pit and you're like, oh man, I don't know if I'm ever going to be able to access this again. It's literally a full-on gamble, friends. Now, we have all these stats and global liquidity, interest rates, China stimulus, whatever the hell is going on. Yeah, we hope it all returns back, but ultimately you don't know. You don't have 100 years of data like the US economy or the stock market. You don't. But that's what makes it more special, and that's what gives you higher return. Stock market's only going to give you 10%. If you're right about your crypto altcoins, you can get like a literally 2,000%, which is like a 19x, 20x gain. Okay, plus. That'd be great. Okay, so crypto is still the best asset in the world. Those 3 years of sacrifice. I mean, look at that, friends. It's been more than 3 years for altcoins. Doge and Chainlink and Polkadot, everything peaked in May of 2021. It's been 3.5 years. Damn, man. So that's been, friends, it's been 42 months now. Wow. 42 months. You can't access your liquidity. Interesting. It better be worth it. I believe it will be worth it. But that's the game, right? There's no free lunch. So you've taken that's why crypto, I always say, friends, I've made videos literally titled, crypto is a long duration asset. That's what it means. Not like bonds as in you lock it up for that, but it's a long duration asset, okay? The way to make the most money is to take the longest term view and hold onto your nuts. This is obviously Ash and Pikachu having fun out here. That's literally it, friends. All of us partying. So now you get to see, even if we go back to this chart. Back here, remember, friends, we had, this is 0 years, okay? You have cash and bonds, okay? Then you have stocks. the high, mid, and low cap stocks. Then we finally get to the Bitcoin bucket. Remember, the low cap stocks, friend, that's the US, that's the Russell 2000, right? Then you have the Bitcoin, okay? Bitcoin, and then even further is the altcoins, because Bitcoin recovers first, then the altcoins come. Now, if you're coming new, you might say, well, what is beyond the altcoins? Well, friends. Well, beyond the altcoins, there's different tiers of the altcoins, right? You know, you have your large cap, your mid cap, and then this will be the question mark, right? This is like the ultimate bleeding edge stuff. But with crypto tech, it lets you access the liquidity earlier. That's why a lot of these things can just do 100x and then just they're dead in the next market cycle, okay? So it's super difficult to look for this thing because this thing's a moving target. Last cycle was NFTs, okay? Before that was like ICOs. It's very, very tough. And everyone believes they're on it. But best part is, man, you don't need to be on it, friends. You know, Bored Ape Monkey JPEG, it minted for $192 at the start in April 2021. Within 10 months, it was now worth $200,000. So they actually peaked at $400,000. So it went up 1,000x. Just think about that for a moment. Okay, went from you don't exist, then you're worth $192. 10 months later, you're $200,000. My gosh, just showing you the insanity that can happen. But it's a unicorn, man. Don't worry about the unicorn, friends. We've seen time and time again. The unicorn doesn't really matter. All you need to worry about is the fact that the money supply keeps going up. All right. And if you want access to that money supply, you're going to keep losing purchasing power. So it's all about that balance. And you know, man, if you just take out that 4 or 5 year time frame, if you can hustle, if you can grind, you eat your ramen noodles, you sit in squeaky chairs, you do your push-ups, eventually you make it to Valhalla, which is you get the highest growth rate because you've waited long and you haven't accessed your liquidity in the middle because it's like super hyper volatile. And you've let Bitcoin clear the high, and then finally we pump to the heavens. This is your friend Somi. Like, subscribe, belly button, all. Don't forget he loves you. Catch you in the next one.